Hello, good evening, everyone, and a warm welcome to our LLF Let's Learn Futures webinar series. We are thrilled to have you here with us today. Before we begin, please confirm in the chat box by typing yes or sharing an emoticon if you can hear me clearly. So if you are able to hear my voice clearly, you type in yes or 111 in the chat box. Great, thank you very much. I appreciate that. Now, today's topic is mastering the techniques to trade in Malaysia's futures and options market. This LRF webinar series is proudly presented by Bursa Malaysia in collaboration with our company Excellent. I'm CY Saw, your moderator for today's session. We are privileged to have David Ng joining us to share about what are the techniques you need to know to trade Malaysia's futures and options market. I see more people have just joined the webinar room. Welcome. Now, before we begin, let's do one final sound check. Please type in 111 or yes, or give us a thumbs up in the chat box if you can hear me clearly. And if needed, please adjust your volume settings to ensure optimal sound quality. To ensure you have the smoothest and highest quality video experience, I highly recommend turning off your video camera during the session, as this will help ensure that everyone can enjoy uninterrupted webinar and have an optimal learning experience. Today's session will be divided into two parts. In the first part, David will present his sharing. Following that, we will have an Q&A session where you can ask any questions related to today's webinar topic. To ensure we can address your questions effectively, please follow these steps. Submit your questions in the Q&A section below and make sure that you send them to all co-hosts. This will help me capture your questions easily. And please note that due to high volume of messages in the chat box, it may be challenging for me to spot your questions if you don't use the Q&A box. So feel free to type your questions in the Q&A box at any time during the session. As part of the LLF Let's Learn Futures webinar series brought to you by Bursa Malaysia, we have lined up of exciting topics ahead. Every Tuesday, we will host a new webinar in this series featuring sessions in English, Malay, and Mandarin. Our panel of speakers will share valuable insights and practical strategies related to futures trading. We have many content-packed and informative topics lining up, so with more being added regularly. So if you're interested in enhancing your knowledge and skills in futures trading, simply scan the QR code to register yourself. And don't forget to add these sessions to your calendar so you won't miss any of them. In addition to the LLF webinar series, we also have the LLF online workshop. Now, this online workshop is different from the webinar as it is specially designed for those of you who are very new in futures trading. In these workshops, we cover a full set of beginner's knowledge in futures trading. It's a step-by-step guide to help you kickstart your first futures contract. Each session is 3 hours long. If you're new to futures trading and would like to learn more, register for these online workshops. They are entirely free and fully sponsored by Bursa Malaysia. And please note that the attendance is limited to the first 50 online participants, so be sure to grab your seats quickly. Now, before we begin, it's my pleasure to introduce our speaker for today, David Ng. With years of experience in derivatives industry, David is a seasoned expert in this field. Previously, he served as the head of marketing at Phillip Futures, where he led the team in driving growth and development in the derivatives market. Currently, David is a full-time proprietary trader with Iceberg X, a proprietary trading firm where he brings a wealth of knowledge and expertise to our session today. So without further ado, I am delighted to hand over the presentation to David. David, the floor is yours.
Yep. Thank you, CY. Thank you, everyone. And obviously, thank you for Bursa Malaysia and as well as Excellent, for inviting me to speak on this platform. And obviously, the audience, especially joining us tonight. Hopefully, you guys have a good meal. And I think in the next hour or so, we'll be mainly covering on some of the key. If you're new to the Malaysia futures market scene, I think we're just going to cover a little bit on the two major contracts which is heavily traded, especially on the Malaysia futures market, which is the crude palm oil contract and the KLCI index futures. So as usual, I think as risk disclaimer, I think any materials presented here is purely for educational purpose, and any opinion that's reflected by me is personally is mainly based on my personal opinion. It doesn't reflect opinion whether it's from Excellent or whether from the exchange itself from Bursa Malaysia. And obviously, I think dealing with futures market does involve a lot of risk. So make sure you're well informed, and make sure you do consult a licensed representative. So we have a list of brokers that's available under the Bursa Malaysia market. Do check it out. Go to the website, and they have a tons of information that can guide you along the process. So I think it's in the next hour. So I think these are the things that we're going to cover. I think first thing is just to give you an idea on what a futures contract is. So if you're new to derivatives trading, futures is part of derivative, and futures options is a bit more complicated, but it's also part of derivative. So I think these two instruments are mainly heavily used when it comes to looking at the derivatives market. So I think just for clarification, the CPO market refers to a commodity index, a commodity futures market, and is Malaysia is being a leading palm oil producer. Palm oil futures contract is definitely in demand, and I think prices for CPO is pretty much a benchmark prices for around the world. Now KLCI is more relevant for those who participate in equity space as well. So if you have been trading or you've been investing in stocks, KLCI index futures is something that you should be well familiar, because it shares the similarities as to how the stock markets behave, as this is the underlying instrument that construct the KLCI index futures. Now, I think as a key part to really look into the futures market, it's important for us to also employ certain strategies. I think one of the key things to look at is to look at the ways of fundamental. Now, if you trade commodities, especially the palm oil market, it's very seasonal. Seasonal in the sense that there's period where prices are high, there's period along the year, and there's also period where prices tend to be softer. So these are all coincide with fundamentals. And because of this seasonality pattern that is quite in place, traders tend to trade according to these patterns. So I think commodities in general does display certain tendencies where, as a trader, we tend to utilize such information to our benefit. Now, if you're trading KLCI index futures, there's certain fundamental factors that actually do have big impact on prices, index prices in particular. So we're just going to explore some of these factors that actually affect the index or rather the commodities per se. I think in the second part of the webinar, we'll be talking about mainly on technical part. Now, as a trader, if you are in the market, I think what is more important is to find entries and exit ways to enter the market and ways to exit the market. If you are trading the market itself, it's important with every decision that you make, we must have a plan in place. So I just want to cover a little bit on how can we form a simple trading plan and trading strategies that we can use, especially when we trade both the FKY and FCPO market. I think last but not least, I think just going to cover a little bit fundamental basics on looking at options market. Now, options are a very good instrument when it comes to managing risk. Futures and options markets is a very well-versed tool when it comes to risk positioning. So, if you're a fund manager for a large company, a lot of these companies, whether you're in commodity space or index space, they tend to use futures and options market quite often because as a way to manage their risk. Now, as a retail traders like us, like you and me, I think options does give a bit of leeway when it comes to flexibility in terms of strategy to express your view. So options in certain ways is in a way more efficient when it comes to pricing risk and also giving if you have a direction and view of the market, if you want to express those views, options can be a good instruments to look at beside the futures market. So I'm just going to start off with just introducing to you what is a futures contract. So ultimately, as we retailers, when we look at the market, we are more concerned on prices. But ultimately, I think what we are dabbling in is basically, when you look into a future space, whatever we are trading is mainly on the futures contract. So if you trade the CPO contract, for example, you're trading a contract of a 25 metric ton deliverable basis. So one contract on the FCPO futures market is for a 25 metric ton equivalent. And every contract is homogeneous. Every contract is the same weight, the same size, the same quality, the same quantity. Because of this, I think a lot of, especially those in commodity industry, they will prefer the futures market given that it is highly homogenized, and every contract is the same. So because of this, it's easy to standardize any of their position. So I think because of Bursa Malaysia Exchange, you're able to trade such contracts on the exchange. So it's highly regulated, and it gives ample of liquidity in the market. So therefore, it actually gives a lot of benefit for those who are trading on the futures market, given that this is an exchange listed contract, and therefore there's ample liquidity within the market. So I think Bursa Malaysia, our local market, especially the derivative segments, have both the equity and commodity futures contract. So commodities is mainly the CPO contracts, and equity is mainly the KLCI index futures. Now, when you dabble in futures market, there's obviously certain terminologies that we need to be aware of. I think first thing is definitely on the expiry of the contract. Keep in mind, if you do futures contract, if you look at the screen, there's always a lot of contracts that's listed in the market. So, for example, CPO, you can trade contracts up to a year forward, and we have volume for those contracts. So if you have a view that is 6 months later, you want to express those views in the market, you can obviously go to Bursa Malaysia Derivative and look at the listed contracts and trade accordingly. Now, the only key, I would say, a key differential between futures and other type of instruments is that futures, there is an expiry. So if you're holding, a palm oil contract, the expiry is at the 15th of the contract month. So if you are still holding that particular contract, normally in the beginning of the month or before even the start of the contract month, normally the broker will probably give you a call and say that, oh, look, Mr. So and so, you are holding a certain contract, and which is coming to a calendar spot month. It's time for you to either roll your positions or get close the contract accordingly. Because unless you have the intention to take delivery, which is a very tedious process, and if you are not if you don't see that benefit of taking a delivery of a physical contract like a palm oil contract, no, there's definitely no point for you to be involved in the physical settlement of the contract per se. So do keep in mind, CPO on the Bursa Malaysia derivative market, it is a physical contract, a physically settled contract. Now, the index KLCI index futures is a different settlement. It's more, it's a cash settled contract, so there's no delivery in certain ways. So at the end of the last business day, which is the last expiry contract of the KLCI index futures contract, you will just automatically cash settle, and the amount will be transferred to your account accordingly. So understanding the time of expiry and the day of the expiry is important. But I believe brokers, they are kind enough. If you're holding a certain specific contracts up to a certain dates, they'll be gentle reminders to be given, and to make sure that you what's your next course of action going to be if you are still holding those contracts. Now, I think the second thing is always about margins. Keep in mind, I think futures is a highly marginable product. Unlike stocks or equity space, you own a stock, it is almost 100% investment. You want to buy a one lot Maybank, it's going to cost you 1,000 ringgit or thereof. Now, if that's 100% required to hold a one lot contract, one lot of Maybank shares. But if you do futures market, is slightly different. Futures market is based on margins, and it's daily settled. As a trader, we always trade the call. We always trade margin calls. That means, position that we are holding currently, the market is against us quite tremendously. Therefore, there is a call from the broker to top up the margins accordingly. Now, because of nature of futures, it runs on the margins and it's highly leveraged. So therefore, the risk potentials could be quite massive. So as a trader in the market space, especially if you're new to the futures market, you must always make sure that you have sufficient margins. And if margin calls were to come, it's best for you to reevaluate your positions again, and relook into your strategy. Because once you have a margin call, technically, there is a call for you to top up, and technically, your positions that you're holding is pretty much against the market direction. Now, tick value is again one principle when you look at futures trading. So the tick value for CPO contract is 25 ringgit per tick. As for the KLCI index futures is half a point is 25 ringgit, so 1 point is 50 ringgit. So every 1 point movement on a KLCI index futures is equivalent to 50 ringgit tick value. And I think one of the important parts of trading futures is obviously talking about settlement price. Now, settlement price is, every day, if you're holding a position in the futures market, the positions are always marked to the market. So therefore, I think all your futures positions are being calculated on a daily basis based on the settlement price that's determined by the exchange. So from then, I think broker will calculate whether there is a need for you to top up on additional margins, or your account balances is sufficient to cater for those margins. So settlement price is an important concept. If you are trading the futures market, you need to understand. So that's how you derive your margin call accordingly. So keep in mind, I think these are the 4 key characteristics of the futures market that you need to know, especially when you trade the futures market space. Now, this is a contract specification for SCPO and FKLI. I'm not going to go too much in it. You can obviously get this information on Bursa Malaysia website, which is very detailed. So keep in mind, contract size for SCPO is 25 metric ton. It's physically settled. So, if you're trading CPO contracts, be very mindful on the expiry date. And the expiry is always on the 15th of the calendar month. And trading hours are slightly different between both. So CPO starts a bit later. It starts at 10:30 in the morning to 12:30 for the first session. Second session starts from 2:30 right until 6. And we have now a T+1, the night session trading, which starts from 9 p.m. to 11:30. So I think hours are slightly different for FKY as well. So if you are familiar with stock market, FKY usually starts 15 minutes earlier. And now with the night trading session that's extended to 2:30 in the morning, in a way, it gives you an opportunity for traders who probably want to catch a little bit of action when it comes to the US market time. When there's movement in the US market, probably can even look at the night trading sessions for the FKY index futures. So minimum tick value is 25 ringgit for CPO. For FKLI, is half a point, which is equivalent to 25. So a point is about 50 ringgit. So now the benefits of trading futures, I think it's very clear cut. Futures is definitely instruments that allows you to go both sides of the market, which means that if you want to express the view that is, if you're very bearish on the market, for whatever reason it is, it's difficult for us to short a certain particular stocks, or to go to short a particular index. I think the easiest way you can do is to go to short a particular FKY index futures, which is very direct product. So it's easy for you to express view using the futures market, because you can either go long or short, and you can even do spreads, calendar spreads, which is a bit more technical per se, looking at the price differential between both calendar months. So I think because of the nature of flexibility, futures market is quite enticing for certain traders who think that they want to express a view that is more of a contrarian, and they can definitely use the futures market to short the market if they are looking at a bearish move in time to come. So second is highly flexible. Third is obviously highly leveraged. That means every contract is based on a margin. So if you want to trade SCPO contract, is based on the contract margin itself. Now margins are on and off. It does change on time to time given the market volatility. So do keep in mind, I think brokers will have most of the major brokers will have a list of the updated margins in given time. So when there's an update to margins, the brokers will update you accordingly. Now, because futures is a highly marginable product, so therefore it's leverage product itself. Now, leverage is always a double-edged sword. Obviously, with small capital, you're able to generate huge profit. But it's the same token, with small capital, you can also generate huge losses, and the losses can be quite extensive. So therefore, in dabbling in futures market, must ensure that you have sufficient risk policy that's in place, especially when it comes to trading. You must always make sure that you have plan for you to get out of the market in case the market go against you. I think last but not least, I think when it comes to futures market, especially the Bursa Malaysia, CPO and FKY is a highly liquid market. You talk about CPO on average, the daily volume you can surpass 30 to 35,000 contracts on the third month. It's a very liquid market itself. KLCI, you are talking about in between a circle of 8,000 to 10,000 contracts per day. So it's very liquid. I think the minimum spread is about a tick size. So it gives a lot of opportunity for traders to be in and out of the market without any slippage or any additional cost when it comes to liquidity issues. So I'm just going to give you some basic scenarios where your positions in the futures market is profitable, and what are the scenarios that your positions are not profitable. Now, in the profitable scenarios, to calculate your P&L is actually very simple. So I'm just taking a drawing example from SCPO contract. So say for example, the current price is 4,000, value per tick is 25 ringgit. Now, if you have a view that the market is going to go up in the next hour or so, in the next day or so, you're probably going to take a long position at 4,000. And true enough, the market went up 10 points to 4,010 ringgit. So that means every 1 point is 25 ringgit. So technically, you have made a profit of 250 ringgit. So in this scenario, you make money because you have expressed the view that the market is going to go higher, given that whatever opinions have arrived, and the market does indeed go higher. So therefore, I think the amount of points that you have made, that will be equivalent to the amount of profit they have gathered. Keep in mind, this has not include commissions and other charges that is incurred whenever you're trading the futures market. Now, in a reverse scenario, is that if you express a view the market is going to go higher, but unfortunately the market, because of other bearish external factors, the market went down. So in this example, you have long a contract at 4,000 ringgit, and the market went down to 3,990, a 10 ringgit difference. So this position is against you. So technically, you're losing money in this case. So simple, I think is a reverse scenario. So every 1 point in movement in the CBO market equals to a 25 ringgit tick value. So in this example, you're losing 250 ringgit. So these are two classic examples on how to calculate your P&L positions. But keep in mind, at every of these positions that you have in the market is always mark to market on a daily basis based on the settlement price that's been determined by the exchange. And that is how you calculate your P&L on a daily basis. And ultimately, that will derive whether is there a call for margin or whether your margin is sufficient. So going into fundamentals of these two products, like I say, I think when you're trading the market space, especially commodities, it's always seasonal. It's always there is always a seasonal tendency that's in place. So if you trade CPO, there's always a period where you think, okay, we are entering a high production period. Prices tend to be weaker. So we see that in prices, and it does reflect into prices ultimately. So these are some of the key factors that affect CPO prices. I'm not going to go too much everything in detail, but I think these are the crucial factors that actually move prices. So first thing is always your S&D, supply and demand. You can't go wrong when you look at commodities. You can't run away from supply and demand. You look at any other type of commodities, be it crude oil or be it your grains like your corn and soybean. Supply and demand dynamics are very crucial. If an oversupply situation, market will likely to come down. If an undersupply situation, demand is very strong, you're definitely going to see a bullish market. Now, secondly, I think ringgit is a very strong influence when it comes to CPO. Given that CPO is priced in ringgit on the international market, obviously with a weaker ringgit, those Western countries will definitely prefer a weaker ringgit because that seems cheaper for them. Now, performance of other vegetable oil like soybean oil is also crucial because rival oils like soybean oil, especially soybean oil, is a crucial factor when it comes to trading the CPO market. So those who trade CPO, they tend to look at or they tend to observe soybean oil performance because these two are quite interrelated. And right now, I think in Bursa Malaysia, they just introduced the new F-soy contract, which is looking at Thailand soybean oil contract together. You can pair that together with the BMD CPO. So that gives a lot of trading opportunities. Now, tax policies are also crucial. These are all impacting when it comes to demand. So when you have strong or you have high export tax, especially when Indonesia impose a very high levy or a very high export tax, that usually affect demands. So as an importer, if Indonesia's goods seems to be more expensive because of higher tax, probably will just shift over to Malaysia, given that the tax regime in Malaysia is probably more competitive and it's more favorable to importers. Now, weather is a very big phenomenon when it comes to commodities, and it's a factor that's very hard to predict. Now you see that weathers are very erratic, whether it's down to global warming or not, but weather is getting very volatile. And because of that, I think commodities are usually heavily impacted by weather. You have an unstable weather scenario or unstable weather pattern that will influence prices. Government policies is another factor that is also very hard to predict. If you've been trading CPO market, you recall, back in 2 years back during the peak of the COVID-19 pandemic, when the biggest producing country, Indonesia, decided to safeguard their production and not to export out any of their palm oil out of the country. That really caused a massive rally in prices. So I think that's where we really need to be looking at. But again, these factors is very hard to predict. Last but not least, biodiesel demand is very relatable to crude oil. So when you have high crude oil prices, usually we blend palm oil with crude oil. We call it biofuel. In a sense that because there's more incentive when crude oil prices is high. There's an incentive for biofuel producers to actually blend palm oil with crude oil as a way to reduce costs on because countries like Indonesia, they are heavily oil importing countries. So when you have high demand for crude oil, that will definitely impact their economy. So this is basically the production trend for Malaysia. You look at it, I think palm oil is very seasonal when it comes to production. So you can clearly see that there will be periods from January to December. Rising periods in production usually starts in April onwards. So April onwards, you can see that production pattern in Malaysia will start to increase. Now, right, when production, if you just look at over the past 10s or over the past decade or so, it's very clear cut that production tend to decrease usually at the year end or fourth quarter. Now, if you look at prices, as I mentioned earlier, when supply is strong, prices tend to be weaker. So right now we're entering to period of rising production. So if you are trading the market, it's very crucial to watch numbers coming from MPOB. We have been trading CPO. You need to take note that every 10 of the month, calendar month, we usually have the Malaysia Palm Oil Board report. And those data are very relevant because traders, markets are watching it. Any deviation from estimates or expectation, that will move prices. But I think based on this production pattern is quite seasonal in a sense that we're likely to see production tend to rise after April onwards and right to the peak probably around October to November. Now, this is basically looking at production and CPO prices. So it's again very clear when you have rising production, normally that will not benefit prices. And when you have no production that's coming down, normally that will benefit prices. So it's actually very very S&D driven supply and demand dynamics when it comes to CPO market. So as seen the peak here, you can see CPO reached an all-time high about close to 8,000 ringgit. You can see production during that time was actually very bad. A lot of estates are locked down. Workers they are having labor issues, so therefore production actually took a severe impact. And because of that, I think prices reflected a strong rally. So keep in mind when you have rising production, that normally be a pressure for prices. Now, I think next part is looking at stocks. So I think clear if you look at Malaysia stock levels, if you just draw a line over the past 10 years or so, any levels that's above 2 million tons, which is considered a bit high, that usually be pressure on prices. For the simple fact that the high stocks, normally that prices will have to adjust to bring down those stock levels down. So anything that's below 2 million is considered quite tight. So we have seen stock levels went to even below 1 million tons, and usually that will not sustain. You just probably given a couple of months, so slowly the stock levels will start to replenish. But I think it's crucial to take note. So if you've seen the rising stock levels in general, normally means it's definitely going to be pressure on prices. So you can clearly see here, I think this chart actually relates better. The blue line is actually your CPO prices against the red line, which is your stock levels. So you can clearly see where every time when stock level starts to decrease, especially during the all-time high prices in CPO during the early part of or late part of 2021, you can see stock levels actually went to probably about 1.2 or 1.3 million tons, which is very critical. And you can see clearly that time we hit an all-time high for CPO prices. So stock levels, when it's elevated, it's definitely going to be putting a lot of negative pressure on prices. Now, if you look at stocks trends, it's very similar to production. So if rising production, if it's not met by strong demand, normally stock will rise. And if you just look at the pattern for the past 10 years or so, stock rise is actually quite in tandem with the rising period in production. So, stocks and productions are quite in line. We are now in a season where, productions are starting to rise. So we are also expecting the stock levels to also slowly inch higher. Now, coming to Malaysia exports. Now, Malaysia exports are a bit tricky. Exports we can't really see a clear pattern. But what is imaginable is that you can see strong periods like around September, October. Usually, these are the periods or months where exports for CPO tends to pick up a bit more. Given the fact that usually India, before they celebrate the Diwali festival, they'll probably demand a bit more of CPO. And during that time, 2 months or probably a month before the Diwali festival, they'll probably be picking up or ramping up their demand for CPO market. So I think therefore that also pushed the Malaysia exports higher. But ultimately, I think demand perspective is less of a clearer picture. But I think the production and stock is quite there is a seasonal tendencies that's in play. While for I think exports on the other hand is slightly of a different picture altogether. Now, it's also crucial to watch on importing countries. I think the two major importers of Malaysia palm is definitely China and India. China is a very large player in most of the commodity space, whether you talk about crude oil or any other major commodity markets. So if China stocks are low, normally that's a good sign. That means China will have to replenish those stocks. So when China starts to replenish, that means they will just go to open market and just buy palm. And that would definitely push prices higher. So right now you can clearly see the figures this year so far, year to date, suggests that I think China inventories are actually quite on the lower end. I think eventually these inventories will start to pick up, so which translate into China demanding more of Malaysia palm. So now this is basically to show you and to highlight to you the relationship between crude oil and CPO. So the orange line is actually the crude oil prices, and the black line is actually your palm oil price. So you can clearly see both these markets move quite in tandem and quite in line. Reason being, as I mentioned earlier, palm oil is being used as a feedstock for biofuel. So with rising crude oil prices is actually benefiting palm oil prices because high oil price, there's more incentive for biofuel producers to produce biofuel, to blend palm oil with crude oil as a way to save costs and as a way for the export market as well. Now, this is looking at palm oil and soybean oil. Again, you can see there's a very close relationship between these two commodities. It is almost quite high probability that whenever you see strong prices in palm oil market, probably you could also see a similar strength in the soybean oil. And soybean oil, this is in reference to the US soybean oil seaboard market. So you can see prices of these two commodities are actually quite moving in tandem. So it gives a lot of if traders are looking at factors to gauge the direction of the palm oil market. I think one of the good gauge is to look at the soybean oil performance. Now, there is always a spread between these two commodities, between the palm oil and soybean oil. I'm not going to go too in detail, but in normal circumstances, there is always soybean oil always trades as a premium compared to palm oil, Malaysia palm. There's a couple of reasons for it. But I think because of this premium that's over the years has actually been lingering around 100 US to 150 US dollar per ton. But I think during the height of the pandemic, we have broken out the range. It went to as high as almost 800 US dollar. That's proof unsustainable. When you have such a high premium, it's just telling you that soybean oil is way overvalued, and either way, your palm oil is way undervalued. And I think sooner or later that spread has actually adjusted. Now I think we're back to its long-term average about 100 to 150. So do watch out on these spread dynamics, because any breakup, when you see a very steepened spread premium between the soybean oil and palm oil market, usually it try to signal you that one of these markets is actually undervalued, and that could be a trading opportunity for you to look at. Now, weather is an important play, like I mentioned. So weather is, when it comes to trading CPO, I would say there's two weather extremities that we need to be aware. One is El Nino and one is La Nina. So El Nino relates to dry weather. La Nina relates to wetter conditions like that will be your monsoon period. So I think if you just look at some of the major weather model, you can clearly see that the world is transitioning towards from El Nino to La Nina. So when these kind of things happen, usually palm oil production will take an impact, and that will move prices. Now, if you compare El Nino and La Nina, El Nino have a bigger impact because dry conditions will affect production even more. Wet conditions it does impact mainly because of harvesting and logistics issue. When the field is wet, you have more mud. It's very hard for the harvesters to go in and actually harvest the fruits. So that's one of the major reasons why even La Nina events can cause production decline. But El Nino is a more severe impact. So whenever there's El Nino happening, you can clearly see prices tend to rise quite substantially. Now, just to look at ringgit and CPO, you can clearly see generally when you have weaker ringgit, it tends to favor stronger CPO prices for the fact that a lot of Western countries, especially the Western buyers, when their currencies are based or relative against ringgit, when ringgit gets weaker, that means they can buy or they can purchase CPO at a cheaper price relatively. So that will actually increase their demand for CPO. So eventually that will drive prices higher. So that's the relationship between ringgit and CPO. Generally, when you have a weaker ringgit, it tends to favor CPO direction as well. So that's pretty much on commodities and CPO. So factors affecting CPO, actually, some of them are very S&D driven, supply and demand. So it's actually down to supply and demand. So if the market is an oversupply market, that means it's generally going to be pressure on prices. And if it's a very tight market, low stock level, probably going to see stronger CPO prices. So moving on to FKLI. Now FKLI is more of the index futures. So the factors affecting the index futures is not the same as the factors affecting commodities like CPO. So for index is pretty much down to the KLCI index component stocks. We have 30 of them. So performance of each of these index related counters would definitely have an impact on your KLCI index overall. Now, index futures or index itself is very relatable to the domestic economy. So if the domestic economy is strong, normally you would translate into stronger growth in terms of your domestic index. Ringgit is also a major player again. I think both the CPO market and FKLI market, ringgit has quite a major influence. So when it comes to FKLI performance, ringgit has pretty much also determined the direction for the FKLI market as well. Now, other benchmark indices, this is especially relevant to the US index market. Whatever the US markets tend to have external influence when it comes to KLCI index futures. Now, crude oil is also one important parameter because Malaysia is actually very oil-driven economy. So when you have high oil prices, that normally means there's stronger growth in its domestic economy. That means there's probably could be more strength when it comes to the index market. Now, geopolitics, whether it's domestic or international, it's also bound to have impact on our local bursa. So geopolitics is something that's again is a factor to watch out, and something that's not easily predictable. So now, as you've seen earlier, a weaker ringgit when it comes to CPO market tends to favor better because Western buyers will have more bargaining power or more purchasing power when you have a weaker ringgit. Now, on the FKLI performance is on the vice versa. That means when you have weaker ringgit, that tells you generally the economy is not doing that well, and that means the index are being dragged down. So you can clearly see when you you have a very weak ringgit. Generally the KLCI index tends to go on a bearish mode. When you have a stronger ringgit, that probably can lift up sentiment in the index market as well. So the ringgit play when it comes to the index market is slightly on a different perspective. It's actually more to how it relates to the economic strength of the market itself. Now, stronger domestic economy is always a plus when it comes to index, and it's very relatable as well. For the simple fact that if you have a stronger GDP, the GDP growth is growing. That means the economy in general, the economic engine in general is growing. So that means index, there's more momentum for index to go higher. So that's in a way is quite coinciding in the strength of its economy. Now, crude oil prices, like I mentioned, Malaysia is very oil domestic driven economy. So you can clearly see when you have high oil prices, generally that benefits KLCI. Because a lot of the trade, a lot of Malaysia exports are still oil dominant. So oil prices normally benefit the KLCI index in general. Now, this is looking at external markets. I think one of major markets that does have quite a bit of influence when it comes to the Malaysia index market is definitely the US Dow Jones or US major indices. So you can clearly see, I think there is clearly an quite parallel movement between both markets. Now, there's a bit of divergence since after the pandemic. You can clearly see US Dow Jones are pretty much on an uptrend rally and it's hitting all-time high. Malaysia market is still yet to reach that level. But I think in recent times, in recent months, we have seen that relationship tend to exist, whereby if you see a stronger Dow Jones, probably you also could see a stronger KLCI performance as well. So I think that could probably be a factor to look at whenever you are trading the KLCI index. Now, this is looking at constituent stocks that is under the KLCI index. I think majority, at least the banking sectors comprises probably about 30 to 35% of your index movement. So it's actually quite substantial. So performance of banking sectors in Malaysia does carry weight on the KLCI index. So here, what I did is just to look at chart between the KLCI index together with Maybank stock chart. So you can clearly see it's actually very parallel. If you really want to, if KLCI index does go higher, that usually means the banking counters tend to see more strength, and vice versa. So because all these are constituents under the KLCI index, so definitely any of the big movement in the constituent stocks will have an impact on the KLCI index. This is for CMB. I think banking sectors generally is a very heavy weightage on the KLCI index constituent. So if you really want to see how how resilient is the KLCI index, do look at the constituent counters especially. And the banking sectors does carry a bit of heavy weight when it comes to the reflection in the index itself. So going to the third part of the webinar, I mean looking into technical. Now technical is very in a sense that it aids you, it gives you the tools necessary for you to make decision. But then again, always you must have a leeway to make sure that you have flexibility when things are not doing well. What should you do, and and when should you be, or where should you be getting out? The key thing is always you must have a plan when things go wrong. And because trust me, most time things can go wrong. And that is where it can make or break a trader. So importantly, when you want to come up a plan itself, a trading plan per se, you must incorporate ways and strategies for you to get out of the market in case the market goes against you. So creating a trading plan, first thing is to identify the overall market trend, visually or using technical indicators. So visually, it's just looking at the chart from left to right. Is it going higher, or is it going lower, or is it going sideways? So Dow theory always precedes that, if you see a highs as subsequently higher highs and higher lows, that means the market generally is on an uptrend. If you see lows and higher lows, that usually also signifies uptrend in place. Now, if lows are going nowhere and the highs are quite stagnant, that means the market is sideways. And normally in the downtrend market, the highs are always getting lower, and the lows subsequently as well. So that's how we see charts visually, or trends visually, based on just looking at the highs and lows of the particular candles. Now, secondly, I think it's looking at candles. Now, the candles that I choose to use is actually a trend trading tool, is what we call Heikin-Ashi candles. Now, Heikin-Ashi candles are is part of Japan's candlesticks. The reason why Heikin-Ashi candles is used as a trend trading is because when it comes to trend, color identification by Heikin-Ashi does allows you to see trend in a clearer manner. So sometimes when you're not sure whether the market is still on an uptrend or downtrend, I think Heikin-Ashi can point to you that out quite easily. So if you pair that with certain crossover strategy, especially using a moving average crossovers, you probably could get quite a good entry strategy per se. Now, and I think always manage your risk by looking at average a tool where you can always manage your positions out if the market go against you. I think one of the best tool to use is to use a ATR, what we call average true range. In a sense, it's actually measuring the range of the day. So if the range of the day is about 50 points, so now that is pretty much how much you're willing to risk per trade based on the ATR value. I'll just share with you why ATR values is quite useful when it comes to managing risk, not only as a way to lock in your profit target, but also managing risk is also quite useful. Last but not least, always make sure you always review your trades because keep in mind, as a trader, it's always a journey. It's never a one-stop thing. So the discipline to always look at your trades, to review it at the end of the day can give you an edge. And it gives you more data points for you to actually evaluate your performance across time. So I think that helps if you're trading this on a full-time basis. It gives you a bit of perspective on how your performance is over time as well. So going into the first part, how to look at trends visually. So you can see here, like I mentioned earlier, if the highs are getting higher and the lows are getting higher, that usually tells you the market is generally on uptrend. So chaos here has actually been a strong uptrend since the start of the year. And obviously, there's a lot of catalysts, given that it's very tech driven, there's the stock of data centers and whatnot. The semiconductor space in Malaysia is doing massively well. So all these are catalysts that actually prop up the index into higher levels. So I think generally, I think KLCI is still pretty much an uptrend unless those key supports are not being violated. No, the trend can still persist till year end. So now, besides looking at trend visually, like the lows and the highs, we can also plot moving averages as a way to gauge where the trend is. So if you look at this is for CPO, no, the candles are pretty mixed. So you plot a 50 period and 200 period EMA line. One is the blue one is the 200 period. The orange one is the 50 period. So you can see candles are trading above slightly to show there's a short term uptrend rally. But if you look at the frame itself from left to right, the market is generally consolidating between, the 1,600 to probably between 1,480 on the longer term perspective. But I think on a short term basis, the FKLI performance are still showing you that the market is still on an uptrend rally per se. Now this is CPO. This is where I mentioned that the market is actually on a sideways. If you look at it, since the start, pretty much the start of 2023, the market has actually been finding it very difficult to break above the 4,400 mark. But it's well supported between 3,700 and 3,800 ringgit. So in certain ways, you look at the moving averages, the 50 period, 200 period, it's actually quite flat, and the candles are hovering between these two spaces. So it does indicate that palm oil is trading at quite a close range, and for it to break out above these ranges, it needs a catalyst. So the way I see it, fundamentally speaking, as we head to year end where things are getting brighter when it comes to the commodity space, especially talk about lower production, stocks are lower, that could be one catalyst to drive prices higher. So the key levels to watch out is really, anything that's above 4,002 is does tells you that the trend, uptrend could be in place. And I think, CPO is very well supported at 3,800 level. And if it does break below that, that could potentially be a short-term downtrend rally we can see in the CPO market. Now, going to Heiken Ashi. So Heiken Ashi is one derivation of Japanese candlesticks, which I highlighted earlier. So there's three distinct patterns of looking at Heiken Ashi. So one is to look at the body of the candle with upper and lower wick. That usually tells you the trend is actually weakening. So if you're holding into a particular trend and see this kind of candle where you have upper and lower wicks, it does tells you that the strength on trend is actually weakening. Now, the best scenario is if you see a body like this, whether it's green or red with no wicks, that tells you it's a strong trend. The trend is in place. So normally in this kind of scenario, it's a good chance, it's a high chance that the market is actually trending. Now, if you see probably a small body with a long wicks, almost like a doji in the Japanese candlesticks, and it's always a series of red and green, it tells you generally the market is going sideways. So I think generally in Heiken Ashi, there's only three distinct patterns. Now, the major difference of using Japanese candlesticks is that you have 100 old combinations, it gets very complicated. and it gets very tedious. So he can actually simplify it for you, and it's easier for you to look at trend or spotting a particular trend in place. So anyway, Heiken actually is based on it's very quantitative. You can calculate the ratios of Heiken is actually based on a fixed formula. You can get that on Google. So if you are using or running on algo or automated trading, I think you can obviously program Heiken actually as part of your trading program. And Heiken actually is very more of a trend following, and it's always identified by the color of the candle itself. So just to give you dynamics, you can see here we have a series of green candles. The bodies of the candles are white, so that tells you generally the market is actually moving on uptrend. As long as the body of candles are white, it generally tells you this uptrend rally still persists. Now, when it comes to this point here, you can start to see the body of the candles are getting smaller, and you can see a series of red and green. When you see this type of a scenario, that means the market trend is weakening. So if you are long position in the market, you should be out of the market. Now, vice versa, you start to see red candles, and the body is very white. That tells you that generally the market is on a downtrend. So these are the period where you should be careful. You should be trying to short the market, because the trend is actually turning down on the downside. Again, when the markets are starting to see smaller bodies, a series of red and greens together, it's telling you the market is going sideways. So the trend that's in place before that is almost coming to an end. So if you're holding a long position here, you should be thinking of probably this is the best time for you to be out of the market, because there's no clear trend that you can see in the market at this point in time. Now, one of the key thing of using Heiken actually is that because if you are using gap analysis, or strategy that look at markets closing up the gaps, you can't use Heiken actually because Heiken actually represent gaps by the color of the body bar. So in a sense that you can't really use gap analysis on Heiken actually. If you want to use gap analysis, you have to revert back to the normal Japanese candlesticks. Now, as I mentioned earlier, pairing Heiken actually with moving averages does give you quite a good a proper entry strategy. So crossovers are actually very simple. If you pair two different periods, one is a shorter period and one is a longer period of EMEs. In this example, I'm using 9 period and 20 period. So one is a shorter term, one is a longer term. So whenever you see a crossover, that usually be a signal for you to be entering the market. So no, this is a bearish crossover. It means that the shorter term is actually crossing below, and you can see red Heiken actually bars. So normally in these circumstances, telling you the market is actually quite heading for potential downtrend in place. Now this is a reverse scenario. You can see green Heiken actually bars, and the shorter term is actually crossing above the longer term. So it's actually a bullish crossover on EMAs. With green Heiken actually bars, it's actually quite a good signal for you to place a potential long entry to capture the potential uptrend in the market. Now, I think obviously the last bit of managing a trade plan is always must make sure a way for you to exit the market if the market go against you. So I mentioned earlier, one of the ways is to look at average true range as a tool for you to manage your targets, your profit targets, and also your stock risk management. Most important I want to emphasize is the stock risk management, because without that, without a proper stock risk management, you are just putting yourself to too much of a risk on open market. So what we have here is that you can clearly see that it's a strong sell signal here, because there's a bearish crossovers and the red candles are actually getting the body of the red candles are getting wider. So ATR at this point in time is about 20 points. This is on CPO market. So one way of using ATR is to probably, if this entry is looking for you to short, so enter a short entry at 3896. Your ATR value is 20 points. If you work on a reward to risk ratio of 2 to 1, so that means you're looking at 40 points of profit, 20 points of stop loss. So you're looking at profit target at 3846. Because you are shorting the market, your profit target is there, and your stop loss at 3916. So that's how you manage your profit target and your stock risk management, based on the ATR value. So this is what happens. So this is our entry level because of the signal that's given, and this is your target that's reached. Now, there's always an argument to say that based on hindsight, obviously it's 100% viewpoint. You can clearly say why not you hold this position until the candle has changed. So I think that's on hindsight, there's always 100% clarity. But when you're at that point of trade, as long as you have created a plan, we have to be disciplined enough to follow the plan. So once the target is reached, you reach. If your stop loss has reached, you're out of the market, you have to wait for the next potential setup or entry. I think as a trader, we really need to be disciplined in that regard to make sure that we are well equipped when it comes to making sure we are prioritizing or managing our risk accordingly. So this is another example of FKLI. So the previous example is on SCPO. So FKLI is also very similar, a similar trade setup. So again, you see a bearish crossover and you see red Heikin bars, the bodies are getting wider. That generally be a good position for it to sell. And the ATR value here is about 4 points. So keep in mind, FKLI, the volatility on an FKLI is generally relatively lesser compared to its FCPO, based on a value point basis. So generally, I think for those who are new, who wants to trade the futures market, I think FKLI is a very good instrument to look at, given the nature of the volatility of the product itself. So the reasons of shorting is actually very clear. You have long body with Heikin bars, with bearish crossover on your moving averages. Your ATR value is 4 points, so that gives you a signal where potentially you should be placing your target, profit target, and where potentially you should be placing your stop loss. So that's how you manage your risk management according to the ATR value. So this is what happened next. So I think pretty much the market is generally on a downtrend. And I think this one is quite a long downtrend before I think the market eventually turn higher. So I think using Heikin entry together, pair that with moving average crossover does give you a fair bit of entry strategies that you can utilize. And ATR value will always make sure that you have a position where in case the trade go against you, you're out of the market. Now, using ATR value to manage risk comes with you have to make sure that when markets gets volatile, when ATR value increases, that means your proportion for you to control your risk will get higher. Or in other words, you're preparing to suffer bigger loss because the volatility of the market has actually increased. So that's in a way, if you're using ATR, you have to be careful. So if you're not prepared to risk that amount, then you have to use a different or other ways to manage your risk accordingly. But the key thing is always must have a plan to manage your risk in any of your trade positions. So the last bit in any trading plan is always to review your trades. These are the key measurement matrix to look at. Your maximum drawdown, your P&L ratios, your hit ratios, and your volume, equity curve. And for us, one of key important matrix, especially for up and coming traders or junior traders, we always want to look at is the time to recovery. Now it's not every trade is always 100% win rate. There's always trades that doesn't go in our favor. So I think in that sense, time to recover is an important parameter. So if a trader takes a very long time, that means he or she must make sure that you must have a very tight stop loss regime, because you can't afford to lose so much, because eventually you take a long time for you to recover. Now, if you are a trader that can able to have a fast or quick around time to recover, that means that normally you are able to withstand a bigger risk, because your ability to recover is actually quite fast. So in that sense, your risk appetite could be greater. So going into the final bit of this webinar, talking on managing risk using options. Now, options in Bursa Malaysia is mainly traded off screen, or what we call usually on negotiated basis. So that's where you need to liaise your broker to get quotes and whatnot. But having said that, it's good for us to understand some of the basic principle of looking at options market. So options and futures are derivative instruments. Options are slightly different compared to futures. So options are talking about the rights but not the obligation to buy or sell a particular underlying asset at a particular exercise price at the period of time. So keep this in mind. There's only two type of options: call options and put options. Now, call options is basically an option to buy a particular asset or underlying asset at a certain date at a certain price. Now, this certain price always refers to strike price. Let's keep that in mind. Now, put option is the other way around. Put options is the option to sell. So always remember this: option to buy is call, option to sell is the put option. So if you are a buyer, always remember this: you have the rights, but not the obligation. So that means, if I just want to buy FKY call with a strike price of 1600 that expires at the end of the year. Now, at the end of the year, if FKY doesn't, no, and this option costs me, let's say 10 ringgit. So at the end of the year, if FKY doesn't reach 1600, I don't lose anything. The only thing I lost is the premium I pay for these particular options. Now, if you are a seller of options, you don't have the rights, but you have the obligation. So sellers of options are don't that you get premiums definitely, but your risk potential, your exposure or risk is unlimited. That means, if the underlying asset goes against you, and if the buyer starts to initiate their rights, that's where you can get caught quite easily. So sellers of options it can be very complicated. It's definitely not for someone who are new to options market. So if you are new to options market, it's best to stick to buying a call or put, if you want to express the view of the market. So these are some of the options terminology. So expiry date, strike price, and premium. So expiry date is very similar to, so if let's say an FKI options, the underlying is the FKI index futures, the expiry date will follow to your underlying asset. So FKI usually ends at the last business day of the month and where it expires. So that's the expiry date. Strike price is something that's new to options market. So if you are doing options, you need to understand what strike price is. So like I mentioned earlier, FKI, or what we call options on KLCI index futures, OKI, we have a strike price of 1600. That's your 1600 is your strike price. And the premium you pay for this call and put usually comes with a price, a premium that you need to pay upfront if you're buying. And if there's a rights for you to exercise, you utilize it. If you are not going to use the options, the amount of money that you're going to lose is probably the premium you pay. That's it. So keep that in mind. I think buyer always have limited risk, but you have quite unlimited potential. So two major other types, whether it's American or European options. Now, Bursa options are mainly the European type, which means that the European options are only exercised only at maturity. American options are highly flexible. You can exercise any time of the day between the start of the options contract to the expiry date of the options contract. So it's highly flexible in that sense. So Bursa Malaysia is more of the European options, which only can expire only at the maturity of the contract. So these are some examples. So for example, here we have a quote 100 lots of OKLI June contract. OKLI stands for options or KLCI at 1560. Now 1560 refers to strike price, and this is a call contract. Okay, and for 140 cents, this is obviously the price or premium you pay for this particular exercise or strike price call contract. Now, different strike prices comes with different premium, as we always see how relatively how far from the strike price is with the underlying asset prices. The further it is, whether your call and put will have different premiums. So obviously, if the options are usually in the money options, which means that you can definitely exercise the contract and gain that value, those premiums are quite heavy because there is a premium to it. Besides, not only the time premium, you're also paying for the options value premium. So in the money options are usually very expensive. At the money options, this is what we call where the underlying asset price are trading quite closely to the strike prices. So there's always a 50-50 chance whether you want to exercise or not. And out the money options are usually those option contracts are far off from the strike prices. So for example, if let's say you're looking at call options for KLCI index futures at 1560. So if the underlying is at 1540, which is below your 1560 call, these options can pretty much say it's going to expire worthless. And anything that is above 1560 strike price, there is a value. So you want to buy a call at 1580 when the underlying is only 1560, it's going to be expensive because there's a value premium for that option. So keep that in mind. Understanding the value option of the premium based on the strike price of the particular contract is important, because that ultimately will be translated to the premium you pay for the particular option. So this is a payoff diagram. I'm not going to go too much. Probably you can have a look at the slides later part. But keep in mind, as a buyer, options are very simple. Your payoff, once the if you once the market, if you are buying a call, the market goes above a strike price, normally that will translate into great profits for you. But keep in mind, you pay the premium, you must factor in the premium you pay. So there's always a break-even point after factoring the premium. So once you're buying a call, you just generally have a view that the market is going to go higher. So keep that as simple as that. If you're buying a put, you have to express the view that the market is going to go lower. That's why you buy a put. So this is a payoff for a put option. So if the exercise price goes, if the underlying asset price goes below the strike price, generally, we try that means the value premium is going to increase, and generally that means for put premium is going to go higher. So keep that in mind. I think if you're buying a put, it generally tells you that you try and express the view on the market is going to go lower. So this is basically a payoff. It's a similar diagram as previous. So now, what's the benefits of trading options? Now, it's very similar to futures. The only thing is that you have calls and puts. That's where it gets complicated. Now it's again a highly leveraged instrument. So again, is probably a fraction of what futures margin is. So the leverage factor is higher compared to using futures. So now using options is highly flexible as well. You can do a lot of combinations. You can do a call options and a long futures. So you can do a call options and long the asset classes. So you can do multiple various strategies. And some of these strategies can be quite complicated. So that's where, if you have a view of the market, you want to express certain views at a particular time period, options is definitely worth to look at, because you can probably cater or tailor your risk according to the time parameter accordingly, and that gives you a lot of leeway. Now, if you're a buyer, your loss are very limited. Your loss are limited to the premium you pay for buying call and put. So, if you are thinking of you're thinking the index is going to close the year higher, and you don't mind to look at options market, and the premium you pay is quite reasonable, I think options is definitely a better choice. So options, buying of the options, especially for buyers, it does gives a lot of it does manage your risk quite efficiently by limiting your loss potential. Now, if the seller options is the other way around, seller options, you only have obligations. So the moment when buyers initiate their rights, that's it. You definitely your loss potential is unlimited, and that's where it can get very complicated. So selling options are very risky in nature, and involve a lot of highly, if you are a very seasoned trader in options market, selling then could be something that you look at. But if you are new to options market, highly recommended to just stick to buying call and buying put. Now, today I didn't really share much on the other parts of trading options, like understanding the Greeks. The Greeks are another parameter that's, if you are trading options, you need to know, especially delta and gamma, which is talking about this the influence of the underlying against the influence of the option price. Now, this can get very complicated, but I think these are part and parcel when you look at the options market. And the problem with option premium, especially the premium side, is that because option does have the expiry, same goes like the futures market. We have what you call a time element. So time elements always gets decayed. Regardless whether you want to exercise or not, the time value, the time premium will diminish over time as we get closer to the expiry. So I think these are the things that we need to be familiar of if you're trading the options market. So I'm just gonna conclude here. I think I just want to end it with a verse from Ed Seykota. I think Ed Seykota is one of a great trader. I'm not sure he write any books, but you can obviously go and Google his profile and his style of trading. So I think he mentioned this: if you can't take a small loss, sooner or later you take the mother of all losses. So the key thing of trading the futures market or the options market is always managing your risk at the end of the day. So I think with that, I'm just going to end here. I'm just going to hand over to CY for any questions from the audience.
It's now time for our Q&A session. So if you have any questions related to David's sharing, please type them in the Q&A box so that I can easily capture and address them. While we wait for questions to come in, I would like to ask a small favor from you. Please take a minute to fill out our feedback form. Since we have provided an informative session today, it will take you less than a minute to complete. You can find the feedback form in the chat box or scan the QR code in your smartphone. Take a quick minute to share your feedback. It will greatly help us improve our future sessions and ensure we continue to deliver a valuable content that enhances your learning experience. So please take 1 minute to complete the form and we will begin the Q&A session shortly. Another 30 seconds to go. All right, 1 minute has passed. If you have already submitted your feedback, thank you very much. For those who haven't finished yet, you can continue to do so. Now, let's move on to the Q&A session. To ensure we cover as much ground as possible, I will select the most relevant questions from the Q&A box and rephrase them for clarity. Please understand that due to time constraints, we may not be able to address all questions. So David, here are several questions that I have already picked out from. So the first question, what is the recommended starting capital to trade one lot of FCPO?
Well, I think this question is actually quite diverse, but I think as a start, it's good to probably allocate between 10 to 20 thousand ringgit to start off with probably a lot of CPO, one lot of CPO. Now it definitely cover 2 to 3 times of your margins. The reason is being because no, you can't have every trade that's successful, 100% hit rate. There's bound to be a time where there's a losing trade, and if you manage your risk position well, I think with the kind of capital that you put in is enough to cover for those period of losses that you encounter.
All right. While we are on the same topic on starting capital, how about for FKLI in order to trade one contract?
I think because FKLI is slightly on the lower end of margin requirements, but again, I still recommended between that range of 10 to 20. 10 is a bit too low on the other end, probably about 20. Reason means because you must have enough buffer for you to probably cover certain margins when, let's say, that there's a margin call on your end. Keep in mind, like I always say, it's all about risk managing. So if you have too tight or too small of a capital to start with, you have a lot of pressure to perform. That means every trade that you make, you pretty much need to make it. If not, then because of the tight capital, you probably be pressured by it in certain ways.
All right. The next question, what days or which dates should I look out for on news that would affect the FCPO?
Okay, there's plenty. I think obviously the major one is on the 10th of every month, which is the MPOB report day. So before that, like I think probably early of the month we have some some estimates on MPOB. So those estimates are also crucial because some estimates can go way off, but market will move based on those estimates first. Other than that, cargo surveillance numbers on every fifth day of the month, so it goes from 5, 10, 15, 20, 25th, fifth, and the last day of the month. So those cargo surveillance numbers are also quite critical because cargo surveillance will tell you whether exports are going on an uptrend or a downtrend. The moment any sign of weakness in cargo surveillance usually tells you, oh, look, things are not looking so good. So you should slow down. So that's some of the key news flow that if you're trading a CPO market, you should be aware of.
All right. The next question. Earlier you shared about the Heiken Ashi candles. How do we get those candles?
Okay, so the platform I've just shared and shared across most of the examples here are mainly on TradingView, but I believe most of the major brokers trading platform does have Heiken Ashi instruments. So just to give you a reference, the TradingView has Heiken Ashi function. I think majority of most platforms will have the Heiken Ashi function as well. I think another one will be Busa Station, but do check your local brokers platform, do ask them, but I believe a majority of them will be able to show you the Heiken Ashi charts.
All right, next question. Is FCPO option liquid enough for retailers to trade, and whether there are any market makers for these FCPO options?
Yeah, that's a good question. Now I think clearly options trades in the market right now is mainly off screen. So that means if you really want to involve in the options market, you really got to call a broker and they really got to give you a code. And normally these transactions are usually involve larger volume. So retailers, you don't have the volume, is very difficult. I think for now, maybe I'm not sure the plan for the exchange or regarding the options market. Probably there is plan for them to probably incorporate more liquidity providers or whatnot. But I think for now, options are still pretty much off screen for the Bursa Malaysia. But I'm not sure what's the plans for the future on this regard from the exchange.
All right, the following question is FKLI Sharia compliance.
Now, as far as I know, I do check your local brokers. FKLI may not be a Sharia compliant, or SCPO usually is Sharia compliant. But again, do check your local brokers. Perhaps maybe they can give you more accurate answers on this.
Okay, the next question that is actually related to FKLI. When there is an index rebalancing or changes in the index constituents, whether will there be any impact to the index points?
Yeah, it definitely does. But I think it won't be much impact. Unless you're talking about the constituents that's coming in now has major weightage on the overall KSI index. So keep in mind, it's always about the weight. So like I mentioned, if there's those like banks which heavy weight and there's movement in there, that will definitely be affecting index points. But you're talking about those coming in and out is only probably about 1% of index weight, then that won't be much of an impact.
All right, another question that is related to option. Is option new trading instrument in Malaysia, and whether is option Sharia compliance also?
Okay, so options are not new. I think that they've been in the market for quite some time. It's just that I think the education acceptance rates are still on the lower end. Again, I think we pretty much the trades right now you can see are pretty much off screen. But it's a good understanding. I think given this kind of platform tonight, we can share with a wider audience just to have a general knowledge on how the option market works. So as to regards the plan on for options market, it is beyond me. But I think it's good to have a general knowledge on the options market. Now, on the part where it's whether it's Sharia compliant, again, it's actually because options there's an underlying product, and if the underlying product is Sharia compliant, then the options is Sharia compliant. Again, I may not give you an accurate answers on this, but do check out your local broker. Perhaps maybe they can give you a better or more accurate answers.
Right. Another question I think is related to trading strategies. In order to trade FCPO or FKLI, what are the common strategies that is easy to follow for beginners?
Okay, I think first thing is Heiken actually to me, I mean, as I explain it, it's generally quite easy to look at trends, to identify trends. So I mentioned earlier the benefits is only 3 distinct patterns. You don't have to go Heiken actually read the Steve Nielsen's book. It has 100 over configurations. That's a lot. It takes time to really master Japanese candlesticks. So Heiken actually, there's only 3 distinct patterns. It's easy, and you're able to do it. Now, if you couple that with moving average crossovers, I think that's sufficient for trade signals. Now, obviously, you can incorporate other tools, but again, all this will complicate stuff. We don't want to be trading on too complicated that eventually it's very hard for you to derive a trading decision. So, I would say Heiken Ashi, moving average crossover, this tool is sufficient. And obviously, you must have ATR, which I show you and highlighted to you. Why is it you need it? and how you use it to manage risk. Because, like I said, risk management is critical and is key. So I think hopefully that's if you're new, start off with this few parameters, few technical tools that you can play around with and backtest it on the respective market.
All right. Another question. When we do charting, what would be a good time frame for us to look at?
Okay. So FCPO, I will recommend 30 minutes. Sometimes can even go down to 5 minutes, but anything below five, you get. If you use Heiken you get a lot of mixed signals. 5 minutes also sometimes you get mixed signals. So 30 minutes is quite ideal. So obviously you can use time frame analysis, start from a bigger time frame, from a wider time frame, look at the daily chart, then move on to 4 hour, then move on to 30 minutes to for the entry time frame. So that's how I recommend based on a time frame analysis. Now FKY is slightly different. FKY can also work on a 30 minutes, but because FKY movements can be quite slow and some certain ways it can be a sideways market. So now you can do a longer extended probably an hour on a time frame for FKY, given the nature of the market itself. So these are the time frames that I would probably recommend whenever you look at SCPO and FKY.
All right. We are going to take a few more questions. Um, are there any difference between futures and ETF?
Yes, there is. So ETF is more of the structure of the product itself. So futures is very exchange listed, exchange regulated. And like I said, futures contract is homogeneous. So so just to draw an example, like if you want to do if you want to get yourself involved in palm oil, the palm. So there's a lot of ways you can go and buy or invest in a palm oil company, which is listed on Bursa Malaysia, or you can go and get yourself an ETF, probably a basket of plantation companies, or you can go to the more direct commodity itself, CPO futures. So I would say, each of these instruments will play its roles differently. So there is always a difference between futures and ETF, but it usually boils down to your how big of your risk tolerance is. So futures, I would say, is homogeneous, is exchange listed, is exchange regulated. So it's more to trading. Now ETF is more to you want to get yourself involved in this particular market with a basket of representative. I think ETF is more suitable in that regard. So it's more of the individual preference, risk preference, and ultimately also is how difference of each product is.
All right. Let's take another last question. Whether is futures or options easier to trade?
Now I would say start off with I would say futures is slightly easier. Options, there's much more terminology they need to know. And I mentioned earlier, options can be very complicated because you can use so many strategies. Buying call and buying put are simple strategies, the most basic strategy you can do in options. We have not covered like doing a straddle, a strangle, a butterfly, a condor. Those can be very complicated. So I would say futures is very clear and direct. You look at the chart, where the chart is telling you. You look at the news, what the news is telling you, and from there you form your opinion, and from there you express your view in the futures market. Options, because you have to take care of the Greeks, the delta, the gamma, all these parameters that need to be taken care of, and you can't really apply chart analysis of options premium. So that's a different thing altogether. So I would say in simple terms, futures seems is an easier instrument to look at before you look at the options market.
All right. Thank you very much, David, for answering our participants' questions. Now it's about time to conclude today's webinar session. Once again, let me remind you about our upcoming webinars, especially for those who may have missed the earlier announcement. The LLF Let's Learn Futures webinar series features a variety of topics scheduled every Tuesday evening from 8:30 p.m. to 10 p.m. We cover a wide range of content-packed and informative topics where you can gain practical knowledge about futures trading from our experienced speakers. If you are interested in joining any of these sessions, simply scan the QR code to register the topics you would like to attend. Once you scan the QR code, you will be directed to a page where you can access our event calendar. To join our upcoming events, simply navigate to the Tuesday column on the LLF webinar topics section. Click on the session that you're interested in and proceed with your registration accordingly. In addition to our webinars, we also offer the LLF online workshop. Now, this online workshop is tailored for those who are new to futures market. If you're interested in learning about futures trading in detail, then this online workshop is ideal for you. Take a picture or screenshot this page and register yourself after this webinar ends. And feel free to share this event with your friends and families who are also interested in futures trading. We will guide you step by step on how to start your first futures contract. And please note that each session is limited to the first 50 online attendees, so be sure to register yourself quickly to secure your seat in both workshops. Once you scan the QR code, you will be directed to a page where you can access to our event calendar. So to find the LRF online workshop sessions, look for them in the Saturday column. Click on the workshop session that you are interested in and proceed with your registration from there. Bursa Malaysia hosts a website called Bursa Marketplace where you can explore a derivatives trading simulator. Now, this trading simulator allows you to engage in paper trading, helping you familiarize yourself with using a futures trading platform. You can register for a risk-free trading experience and give it a try to start developing your interest in futures trading. It's a great way to learn and gain hands-on experience through this trading simulator. Finally, before we conclude this webinar session, allow me to introduce you to Bursa Academy. This Bursa Academy is a comprehensive one-stop e-learning platform where you can access all the information and knowledge about stocks, futures, and other products traded on Bursa Malaysia. You can easily access to Bursa Academy by scanning this QR code on your right or by searching for Bursa Academy on Google and to find this link. Visit Bursa Academy for more detailed information and resources. It's available resources to enhance your understanding of trading in Bursa Malaysia. Alright, we have come to the end of our webinar session today. Thank you very much, David,
Thank you, CY.
for sharing so much information with us. And to all of you who have joined us, thank you for your participation. We hope you found this webinar both informative and valuable. I believe you have gained a new knowledge and how to trade derivatives market better. So with that, I'm CY So signing off for now. Enjoy the rest of your day. Good night, goodbye, and until next time. See you.